Hell is coming. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, the countdown to chaos begins, and I want you to see why this is going to send shockwaves through the global banking system. Now, you may remember the last time we saw something ignite and catch like wildfire through the global banking system, and that was the global financial crisis of 2008 and 9. Well, the problem is it's about to happen again. Now, if you're wondering what we're doing in Salt Lake City, Utah, well, we're hoping to catch President Joe Biden and get some remarks from him because he too agrees that this is a time bomb that's just ticking down. Let's over to Bloomberg, where he picked today's story up with a headline: Biden fears China economy is a ticking time bomb. And he's absolutely right, because we know not is it just that their internal demand is slowing down, which is a huge problem for the world's largest exporter, but as a result, we can see that the entire rest of the global economy is slowing down. And one of the big challenges China has is their real estate market is a massive Ponzi scheme that's just waiting to blow up. In comments that include several major inaccuracies about the world's second largest economy, Biden said at the political fundraiser Thursday that China was in trouble because its growth has slowed and it had the highest unemployment rate going. Now, the fact of the matter is, anytime you see an economy, particularly in a debt-based economy system, that economy then is slowing down and there's a large amount of debt behind it, well, it is a huge problem. And we can look to China, and it's easy to point fingers right now and say, look, they're slowing down. They've got all this debt. They cannot sustain their system, and it's going to come crumbling down. Well, the problem is it's going to happen here in the U.S. as well, because our economy is slowing. It's just not at the same pace or at the same place that China is. But fast forward maybe 3, 4, 6 months from now, well, we'll be having the same conversation as they are. And here we can see he noted that President Xi Jinping's signature Belt and Road Initiative as a debt and noose because of the high levels of lending to developing economies associated with the global investment program. And there is the underlying issue here, is that anytime you have a massive expansion of debt and you have inflation that comes with that, and you start to pull the economy back and start to slow it down, well, you end up not having enough new money created to service all the debt. And next thing you know, things start to fall apart, and China's real estate market is looking like it's about to implode. China was growing at 8% a year to maintain growth, now close to 2% a year, the president said, and it's in a position where the number of people that are of retirement age is larger than the number of people of working age, he said. The statement that was not only incorrect, but off us by about hundreds of millions of people. But this is an ongoing issue when you have a global aging population that is going to start pulling from the system and needs a lot of people to support it, a lot of people who are working to support it. So as we look forward and we talk about how during the next recession there's going to be a lot of layoffs, well, this is going to be a huge problem for governments who have already massively borrowed to get through the pandemic. We're going to be facing even more debt to provide for all of these retirement and old age benefits that they signed up for many years ago. Although President Biden misrepresented key statistics about China, the overall outlook remains grim, and that's the point, because it's getting a whole lot worse and is about to spark a global real estate crisis now that we have not seen since 2008 and 9. China's gross domestic product grew at a slower than expected pace of 5.5% in the first half of the year compared with earlier, leading to worries about ripple effects for the global economy. Well, it's not so much a ripple effect, it's an indicator of what's going on in the global economy. Because if the world's largest exporter is seeing their economy slow down, it's because they have two problems. One, external demand, which is their biggest issue. The second, which we've been talking about and is going to be the focus for today's show, is internal demand is also slowing, and that is causing huge problems in their real estate market, which is about to blow up. China slid into deflation in July and is battling slowing exports, high youth unemployment, and a slumping property market highlighted by a debt crisis for Country Garden Holdings. Now, once the country's largest private sector developer by sales, the company is in danger of defaulting amid an industry cash crunch, or what's well known as a dollar shortage. So here you see one of the biggest developers in China is running out of money. Their economy is slowing down. People don't want to buy property. And next thing you know, they're going to face the potential of a default. Of course, unless there's a major restructuring coming. But even if that happens, and I want to show you some parallels to the U.S. banking system, if we did the similar thing, just in a different sector, because if this isn't fixed, and whatever the fix is not sustainably fixed, what you're going to see is a whole Chinese real estate sector come unwound, and that's going to have major impacts on the global banking system and put us right back in another financial crisis. Once China's top builder, Country Garden, turns into a penny stock. Country Garden's fall from grace underscores how a persistent slump in property prices is weighing on some of China's strongest private builders. Once considered relatively immune to the credit crunch, the Foshan-based developer has become a proxy for financial contagion in an industry that accounts for about a quarter of the country's gross domestic product. So here you can see we've talked about how demand from the outside of China is down. So that means, of course, the factories are slowing down, which we've shown you that data as well. And that means workers there are not confident because they're looking and saying, look, demand's down. We're seeing fewer hours being worked. And that means they don't have the confidence to go out and spend money on real estate and other goods and services. And so as a result, this Ponzi scheme of a real estate market. And if you're not sure what I'm talking about, it's because in China, you buy a property and begin paying on the mortgage. You get it financed, you get the mortgage, you begin making payments oftentimes before they even start building it. And so what you have is a functional Ponzi scheme that needs a constant supply of new buyers to keep the ball rolling. And what we're seeing now is Country Gardens, well, they're just about out of cash and about to go bust. And worries about a debt crisis have increased after Country Garden's dollar bondholders said they've yet to receive coupon payments effectively due Monday. That puts the firm on course for its first public default if it doesn't make the payments within a 30-day grace period. So here what we're seeing, and we've talked about this in the past, when global trade slows down, what you start to see is the amount of dollars circulating around the world starts to decrease. And that means what you're seeing right here in Country Garden is exactly a global dollar shortage, which is what we're seeing in all of the yield curves. We're just seeing there's not enough dollars to keep the economy going. And next thing you know, as we've talked about, this game of musical chairs, there isn't enough dollars. And so when the music stops, people are looking for them. They can't get them, leaving somebody holding the bag, going into delinquency and eventual default. The problem is the bigger they are and the harder they fall, the bigger the ramifications are for the global financial system. The profit warning is likely to prelude an ultimate credit event, which could be the understatement, putting us into a global financial crisis that might already be in preparation for debt restructuring. And again, we talk about this in a moment because up until now, we still see no signs of further government support or bailout. And that is true. We're not seeing a whole lot here. But remember, this is effectively what we did to the U.S. banks. Remember these small, mid-sized banks? And we're going to cover this here a little bit and look at the latest data as they ran out of cash. So we said, no problem. Go to the Fed and borrow it. We'll help you out. Well, here you can see the potential same issue. Oh, you're out of cash. You can't get it. Well, maybe the next step is to restructure your debt in hopes that things turn around. And that is the whole issue. It is hope that in the second half of this year and into next year, things are going to turn around and everybody's going to be okay. The problem will be is when it doesn't happen, what's going to happen to the U.S. banking system and what's going to happen to the Chinese real estate market? Well, you're going to see them both blow up. As Country Garden apologizes for pledging to solve liquidity issues. And one thing you shouldn't be apologizing for are the returns on your trading account, because if you had CTA-Timer Pro, and again, you can sign up for this, it's got a 30-day money-back guarantee. But some of you said, you know, you can't trade crude with this. Well, you can. Here's crude oil. And we had our first signal coming off this bottom right here, this little red candlestick. And if you didn't like that one, and you said, I want to wait for a confirming signal, well, you got it on this green one here. And if you would have bought it open on the second signal to today, at the time I filmed, you'd be sitting on a 15.6% gain, because what our report does is it runs a modeling of how the computers trade the market, and then it does a secondary historical overlay, and it makes all of the difference. Here you can see on July 3rd what happened here, or on July 3rd, what we noticed, crude oil started to go long off of a shorter long position. That was initial signal. Here you see on the 7th, buying again for the second time, giving you the confidence to place that trade. Again, it's only $30 a month. And subscribers saying it's changing the way they trade. They don't need all these other subscriptions. They just need this one. And we put out an update. We'll do this weekend, because we think there's an even bigger trade coming. You got to be on the report to get it, and check that out. Link in the description below. Now let's continue on. Because once China's largest developer by sales, Country Garden struggles to underscore how our persistent housing market slump is weighing on some of the strongest private builders and the economy. And it saw its bonds and stocks plunge this week as everyone believes that it's going to go into default. And that is the issue, because remember we talked about this, you know, last year with the Evergrande issue, where one goes, where there's a cockroach in the system, there's probably more. And sure enough, now we see, back then everyone said Country Gardens, okay, no problem. And sure enough, now we're seeing them on the edge of failure. It only makes us wonder who else is about to go down. And next thing you know, if one falls, you're looking at an entire set of dominoes in China's real estate market start to go up. In a quarter of their economy is real estate. That starts to blow up, and next thing you know, it spreads like wildfire to the rest of the world. And the problem will be is the U.S. banks are functionally doing the same thing, because the Fed has lent them money in the hopes the economy is turned around, and that's not working either, as we see money market fund assets hit new record high as banks' usage of emergency funds jumps. And so you have the same issue as China. What do you see? Potential bailout will come. You watch and see. They're going to do it, and they'll just go, let's restructure the debt. Let's give you more time. It's the same thing we did to the banks here, and look, it's not getting any better at all. The decoupling between money market fund inflows and bank deposits continues to diverge as people chase higher interest rate on money markets, leaving the banks short of cash. And sure enough, all that translates to, as we've noted, is usage of the Fed's emergency bank bailout facility rose by $1.2 billion to a new record high of $107 billion. Now remember, if stress in the banking system was going down, if things were getting better, then what you would see is the banks paying back these higher interest loans from the Fed and getting out of the program. Instead, they're still borrowing more, telling us that things in the U.S. banks are even getting worse, with no sign of a turnaround in the economy to bank on. And will that leave us with one thought? This from Zero Hedge. In 7 months and counting, because these were short-term loans, America's smaller banks will need to find that $100 billion plus from somewhere, and that is when the BTFP bailout program ends, in theory. Will regional bank balance sheets be stabilized by then, or will the current bloodbath in bonds be the catalyst for another round in pain? Or perhaps in the last kind of view is maybe in 7 months, the Fed will be massively slashing interest rates, if they haven't already, putting the banks in a much better position to survive. I think that's a more likely outcome, because we're even seeing some already early signs that China or Beijing is capitulating and looking to bail out things there. It's only a matter of time before it comes back to the real estate developers. As China to shift $139 billion of hidden local debt to provinces and turns tries to do another bailout, all provincial level governments but Beijing, Shanghai, Guangdong, and Tibet will be able to use the bonds they're going to issue to repay off-balance sheet liabilities known as hidden debt in China, according to the people there. Authorities identified 12 provinces and cities as high-risk areas where more support will be provided, including the provinces of Guizhou, Hunan, Jilin, and Anhui, as well as Tianjin City, one person said, and notably, I probably said several of those wrong, but nevertheless, the whole point here is not to pronounce them correctly, which would be wonderful, is to identify the fact that we keep bailing things out, hoping the global economy turns around. And as we'll get to the US data here in a little bit, we're not seeing any signs of that at all. The program suggests that China is reducing the debt load on local government financing platforms to boost their capacity to serve as a channel for future stimulus, again, opening the door for the reality is their economy is not turning around. He had the main buyers, and get this, of the refinancing bonds are likely to be domestic banks and asset managers such as wealth management funds, insurers, and pension funds who will be holding the bag when these loans eventually go bust, which we can likely expect. But are things in the U.S. showing signs of turning around? Well, unfortunately, they're not. As U.S. producer price inflation picks up on boost from services, and this, let's take a look at deeper here, because the hope is that the services sector was going to lead the manufacturing sector up, and that means we're going to see producer prices start to elevate as demand comes back. And while we saw a little bit of demand increase in terms of price pressure, we didn't see enough to move the needle, even though the news thinks so. The producer price index for final demand, which we'll look at closer here, as well as the core index, which excludes food and energy, both rose by 0.3% in July. And while this came in slightly more than forecast, downward revisions to the prior month tempered some of the strength. And here we can see, again, the issue is that producer prices are more a function of the energy sector, as you're about to see. As normalizing global supply chains, tepid demand abroad, again, here's the issue, is there isn't demand, even domestic demand, and a broader shift in consumer spending towards services and away from goods have generally helped alleviate inflationary pressures at the producer level, but that hasn't transmitted yet to the consumer level yet. But headwinds are building again. I love this, as oil prices climb. And here's the thing, I'm going to show you in this next chart that the increase in oil prices isn't a big deal in the big picture to move the needle a whole lot. If it was, we need to see oil prices up well into the 90s and $100 a barrel. But instead, this is what you see here, is that crude oil prices bounced up a little bit here, giving everyone again the notion that all of a sudden crude oil prices on a year-over-year rate of change, which is shown in red, are going to shoot straight up and drive producers' prices higher. But remember, we saw crude oil prices hook higher here again, and now it doesn't mean that oil prices are going up, back up to a level where producer prices will go up. The issue is global demand going to be there? And that's what we're seeing at the producer level, suggesting that perhaps maybe not. But the issue then is, how does this translate to consumer prices? Well, it suggests that even though the CPI went up a little bit on a year-over-year rate of change that we saw yesterday, that the general trend should still be lower. And here we can see on a year-over-year rate of change, the producer price index increased slightly to a mere 0.8%, and when excluding food and energy, up to 2.4%, going to show that how big that energy component is. Here you can see the producer price index by commodity for final demand in red, leading the headline consumer price index in blue, suggesting that this little hook may be nothing more than just something from the base effects from a year ago. And once this all passes through, we should continue to see a downward trend, not only consumer prices, but if demand doesn't come back, and so far we've seen that there isn't a strong sign that demand is coming back, well, producer prices, along with crude oil, should roll over and continue down. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.